But I did want to comment on the returns issue in Japan, because I think the two dimensions there that I think are very important. One is the real return, and it relates to the currency as well. I think the real returns, inflation is so low, the real returns are really quite attractive. Over 10 years, US and UK have performed 8% average. Japan is about 5%. So US, UK much stronger than Japan. But in real terms, because inflation is so low, Japan has been just as strong as the US and UK. So I think when we think about Japan returns, we need to think in terms of real returns rather than the nominal returns. But the other is that the IPD, a lot of people think we talk about market returns, property returns, unlevered returns. If you look at the fund performance in Japan, not the op fund returns, but the core plus returns that we tend to focus on, those are really quite strong over a long period of time, because in Japan, core funds, value add, use a much higher level of leverage because of the low cost of debt, and today it's much more readily available than in most other markets. So you're getting returns in the good years at 15-20% for core type funds, partly because of the market, but as much due to the leverage that's being applied. So I think the US participating in Japan has generally been through opportunistic funds, and the op funds have had their troubles in Japan, as we know. But I think the fund level returns have been boosted by sensible levels of leverage that generate really quite interesting returns, very comparable to what you could get from core plus investing in a nominal way from the UK and the US.
Clearly, leverage is, if you want to push your returns up, I mean, leverage is the way to do it in Japan. That's what the opportunity funds have done. It's so cheap. There are periods of availability and periods of lower levels of availability. Now I think banks are lending. From an overseas player's perspective, you need to be a little bit careful, because I think when funding dries up, it dries up for overseas players before it dries up for local players. So you need to just watch what you're doing there a bit. But it seems to be, I mean, there's always a long-term, a good long-term strategy you can play in Tokyo. A city of 35 million, you've got, as you say, the good real returns, and you've got reasonable cash yields as well. It seems to us the other way you can play that market to really generate very interesting returns, which is what the opportunity funds have done, is to play the cycle. And we had some charts on that. The cycle, but the thing to remember about the cycle in Tokyo, or we find, is it's a relatively short one. It's somewhat geared to the world trade cycle. It's 3 to 4 years. If you can get in at the beginning, I know it's a big if, and out at the right time, which it's not impossible in Japan, because it is a relatively well-behaved, obvious cycle, and then you gear up to very high levels, then you can get some very interesting returns there. I think some of the problems recently have been where the opportunity funds just didn't get their timing right. The big funds didn't get their timing right and didn't get out quick enough. So people got caught by the downturn. And I think that people sometimes get suckered into believing Japan, the big picture on Japan, which it's a large, stable market. Ergo, there's not much volatility there. But actually, particularly the office market, it's quite cyclical, and they're quite short-term cycles as well. So if you're going to do the gearing thing, which is a good way to generate returns, you have to get your timing exactly right. You can do it, but you have to really know what you're doing there. And as I say, there are a little bit of nuances in the capital markets about who gets allocated funds when they need them, depending on whether you're a local player or not.
Just in terms of the amount of leverage, what sort of levels are you talking about?
Well, I mean, I think the cost of debt is so cheap. You can push your leverage on funds up to 90-95%. I mean, as a house, we don't do that, but that's what you have to do to really get the sort of US 20% IRRs that the kind of US opportunity funds typically look for. And you can, it is a viable strategy. As I say, we're a very risk-averse house. We would never do that. but you don't necessarily have to push the risk. You're not necessarily going that far out on a limb risk-wise by pushing gearing all the way up. Except you do have to watch the cycle pretty closely.
We're developing global fund index. We have fund indices in 10 markets around the world, and we're drawing together as a global core fund index, and that's fraught with challenges, because what's a core fund in the UK? Maybe it's got 5% leverage, less than 10%. Australia's a big debate. What should leverage be? It's got to be below 20%. A lot of European funds, their leverage is maybe 30-40% as core, and in Japan I think it's more 30 to 50%. So I think probably the highest levels of leverage in a core type fund within Japan, because of the availability and the cost of it.